GAP3S. While all eyes are on the U.S. China trade war, there's one country quietly cashing in big time. Mexico is emerging as an unexpected winner in Trump's new trade war strategy. But how did this happen? Let's break it down and see why Mexico is thriving in a time of global tension, while the US and China are struggling. Since the beginning of Trump's presidency, trade wars have been a central theme of his economic policy. The aim? To reduce the US trade deficit and revive American manufacturing by putting pressure on countries like China, Mexico, and the European Union. By imposing tariffs on Chinese goods, Trump hoped to bring jobs back to the US and force China to the negotiating table. However, these tariffs didn't just target China. They were extended to key countries with which the US had significant trade imbalances. But as we'll see, some countries, especially Mexico, have found ways to adapt and even benefit. So why Mexico? Mexico shares a unique advantage. Its proximity to the US, along with its membership in the USMCA, which replaced NAFTA, Mexico's economic environment has become a much more favorable place for US companies looking to dodge tariffs. When companies shift production to Mexico, they benefit from lower labor costs compared to the US and China. According to a 2024 study by the Wilson Center, labor costs in Mexico are about 30 to 40% lower than in the US, making it an attractive option for manufacturers. Additionally, Mexico's economy has grown due to its exports to the US, which now total nearly $700 billion annually, according to the US Census Bureau. Foreign direct investment in Mexico's manufacturing sector surged by 17% in 2024, with companies from around the world setting up production facilities in Mexico to avoid US tariffs on Chinese goods. The US-Mexico Chamber of Commerce reports that Mexico is now home to nearly 50% of US manufacturing outsourcing. Leading companies like General Motors, Ford, and Tesla have ramped up production in Mexico, thanks to both the trade agreement and more favorable tariffs. Let's look at Mexico's automotive industry for a second. In 2024, Mexico became the world's fourth largest producer of automobiles, and Mexico's car exports to the US increased by 20%, totaling over $50 billion in 2024 alone. That's impressive growth in a challenging global market. But what about real-world examples of supply chains shifting to Mexico? Let's take Foxconn, one of the largest contract manufacturers in the world. Foxconn, which traditionally made electronics in China, has recently announced plans to expand its manufacturing footprint in Mexico by 30% to accommodate United States demand. Another example, Tesla. In 2023, Tesla opened a gigafactory in Nuevo León, Mexico to manufacture components for its electric vehicles. This factory will supply Tesla's United States plants, bypassing Chinese tariffs and keeping production costs lower. It's not just the automotive or electronics sectors either. Mexico's aerospace industry, which has grown by 20% annually in the past decade, has seen United States firms like Boeing and Lockheed Martin shift some of their manufacturing to Mexico to mitigate tariff risks and optimize logistics. The geopolitical implications of Mexico's rise are enormous. As Mexico gains economic strength, the United States is becoming more dependent on it for key industries like manufacturing, electronics, and even agriculture. The new USMCA agreement, which replaced NAFTA, ensures that Mexico can remain competitive by allowing goods to cross borders more efficiently. In fact, Mexican exports to the United States have been growing at a rate of 4 to 5% annually since the USMCA was implemented in 2020. This also affects China's standing in global trade. With United States tariffs driving American companies away from China, other countries like Vietnam, India, and Mexico have emerged as the winners in the shift away from China. Mexico's future is looking bright, and the country's trade relationship with the United States will likely continue to deepen in the years to come. Goldman Sachs predicts that Mexico's GDP will grow by 3% annually, driven by manufacturing and exports, well above the global average. In fact, by 2025, Mexico's trade surplus with the United States is expected to reach $100 billion annually, up from $75 billion in 2020. But there are challenges ahead. Despite the gains, Mexico's economy remains vulnerable to global trade fluctuations and political risks. As Mexico becomes more integrated into the United States economy, it will face more pressure from external political factors, like the ongoing trade war with China. So, is Mexico's rise a win for the United States economy, or just a short-term solution? Will nearshoring continue to benefit Mexico, or will global tensions shift the tide again? Let me know your thoughts in the comments below. If you enjoyed this deep dive into Mexico's role in the trade war, don't forget to hit the like button and subscribe for more videos about the global economy. We've got a lot more coming your way.